Hey guys, my name is Mike Boyd, this is The Money Flare, and in today's video I want to give a market update for the month of May. So what happened this month, how did the MF portfolio perform, and how am I positioning myself for the next month. Now if you haven't watched my previous video on the top 10 investments for May, please do so. It shows how I'm currently positioned in this market and why. And in that video I said that I'd like to track the MF portfolio performance over time and give updates. Only a month has gone by, so not much has changed since then, and the core of the portfolio remains essentially the same with just some minor tweaks and changes, so making another top 10 investments video for June I thought was unnecessary. What I'll be presenting today is what I believe will continue to do well going forward, and once again I say this all the time, but none of this is investment advice. I'm simply presenting how I'm positioned in these markets and hopefully presenting an example of what I think is a well-designed and well-diversified portfolio to help anyone watching manage their own portfolios. So let's get into it. What happened this month in markets? Well, we got much more confirmation of the view that I've been expressing now ever since I started this channel, which is that growth and inflation are increasing. And just a side note, I want to go over something because I mention all the time growth and inflation, but I talk about them a lot because I think they're the two most important metrics for determining where we are in the current economic cycle. Markets and economies move in cycles like a sine wave, and you can clearly see this in the chart of GDP growth over time. So this is the GDP growth rate of the US over time, and you can see that it increases and decreases like a wave. And you see the same thing with inflation. Here is CPI inflation in the US, right? Up and down like a wave. We go through cycles. Some are short-term, some are long-term, and you want to own different assets in different environments. And navigating these short and long-term cycles is what our job is as investors. And while the economic cycle does have an impact on markets, it's also important to remember that the economy isn't the market and vice versa. Markets move on how the economy is going, but they also move in response to things like market positioning, so how everyone in the market is invested, and they move on sentiment and flows, which are all not related to the economic cycle. So it's important to keep in mind all these factors when investing and trying to beat the market like I am. So let's look at the big picture. Since March 2020, we've been in the upcycle after recession, where growth and inflation have increased. And in the depths of the COVID crisis, central banks used extreme monetary policy and they expanded broad money supply. And as you can see in this chart here, increases in broad money supply in blue tend to lead to increases in inflation in orange. And we've had these spikes many times in the past, and they have always, or for the most part, led to inflation, increases in inflation. And that's exactly what we're seeing now. Year over year, inflation came in at 4.1% earlier this month, and core PCE, which stands for personal consumption expenditures, it's just another gauge of inflation. That one is growing at 5% over the last 3 months. And many of the inflation surveys, so here the University of Michigan inflation surveys, the expected changes in prices for the next year, that's increasing, as well as the changes in prices for the next 5 to 10 years. So all those inflation surveys are also pointing higher. We also had positive economic data. So on the manufacturing side, we had the global manufacturing PMI, which is just an indicator of the overall health of the manufacturing sector. We saw that rise to an 11-year high in May. We also had job postings up 24.2%, above pre-COVID levels. We had personal income per capita, so the personal savings rate, how much money people are saving. We saw that rise to 28%, which is the highest ever on record. And here's the chart going back to 1960, and you can see that typically the personal savings rate hovers around 10, or did hover around 10% before the 90s, and then it dropped maybe to 5 to 10%. But recently it shot up to 28% because people have stayed at home, they haven't really spent money, and they were receiving stimulus checks. And we saw that effect in the retail sales number as well. We saw retail sales were up 20%. Which is the highest ever on record as well. So you can just see, if I zoom in, you can see how quickly retail sales rebounded after the low in March, right around here. And so it seems the stimulus checks had an effect on the consumer. And so they spent it on things like shopping, and they spent it on meme stocks like GameStop and AMC. And as I've shown in my previous videos, the place to be invested this whole time was in sectors of the economy that do well during strong economic growth and inflation, which is energy, materials, industrials, banks, retail, commodities, things like that. And that's how I've structured the MF portfolio so far, and it's been performing very well. So you don't want to own the high valuation tech stocks like Tesla, shown here, or neo in this type of environment. So we've had this extreme monetary policy from central banks and huge government spending to get out of the COVID recession in March 2020. And so now we're at an important junction, in my opinion. We've already seen this huge spike in growth and inflation and a huge recovery in the market. But now the data going forward, I think, will naturally slow down. We've already reached these really elevated levels. We've seen such a large rebound, and people in markets have high expectations for company earnings. And so we might be likely to disappoint as we go through just the natural down cycle of the wave that I mentioned earlier, right, of GDP, the sort of sine wave of GDP growth and inflation. And so if earnings growth, GDP growth, and inflation growth, if they're all likely to slow down from this point, we might see some issues. This is also coming at a time when interest rates are rising and central banks might be forced to reduce the amount of support that they're giving to the market. So they might need to pull back some of that liquidity and start talking about increasing interest rates going forward. The long end of the yield curve, so the longer end, the longer dated maturities of bonds and yields. So here, for example, the US 10-year yield, this is the interest rate on a 10-year government bond in the US, right? It was increasing, but recently it's taken a pause in May. But it appears that it's just sort of consolidating before continuing higher. And so I see interest rates continuing to rise, which would put pressure on central banks because it really doesn't make sense for central banks to continue to pump money into these markets and to inflate asset bubbles. So what does that mean? If we have growth and earnings and inflation potentially slowing down while central banks could potentially pull back their liquidity and start talking about increasing rates, we could see markets take a huge tumble like what we saw in 2019, which was not pretty. So if you go back here, right? Here we were in an environment where the central bank was pulling back its liquidity, it was increasing rates, and markets completely, they crapped the bed. They crashed at the end of 2018. And so it wasn't pretty. And so there's a lot of room now to go down if we were to see that happen. And I've gone over this many times in previous videos, but there are so many signs that the markets right now are very stretched, right? If you just look at the long-term chart of the market compared to the long-term trend line, we're pretty high above that trend line, right? We're even higher than we were in the year 2000, right? During the tech bubble. We're at 169% above the trend line. So we're definitely stretched. And I always say valuations are never a catalyst, but if markets do fall, they are falling from a very high level. So that could create a much more violent move. And so we'll see what happens. I'm currently on the lookout for that possibility in the next few months. So I'll be looking to sell a bit of the portfolio, hold a bit more cash in case this were to occur. One last thing I want to mention about inflation. We really haven't seen sustained inflation since the 1970s. So everyone now expects that the inflation that we're seeing to be transitory. So they think it'll be very short term, won't last, and it'll come right back down like we had ever since the 80s, right? We had inflation, here, let me zoom in a bit, right? We had inflation trending downwards. We had some spikes up, but these spikes up never lasted, and the long-term trend was just down for inflation. Now, I'm definitely going to make a separate video on the whole inflation debate because I have my own views. But just to keep it short, let's not discount the very real risk that we could see longer lasting inflation this time around. Inflation could take a pause, and so we could see in the next few months, as I mentioned before, right, we had inflation spiking to 4%. We could see it come down a bit, but there is, I think, at least, there is a high probability that we could see inflation, CPI inflation, make a big lower high and then continue to climb higher, like what we saw in the 1960s and 1970s. So if I pull back, right, so in the 1970s here, right, early 70s, we had inflation spike, we had it come down, but it made a big lower high, and then it continued trending higher, right, all throughout the 60s and 70s. And you might be asking yourself, how could this be possible, right? How could we have long-term inflation? And in my opinion, at least, I think it's because we seem to be entering a new paradigm where fiscal policy and government spending is on steroids, financed by central bank money printing. And just take this article as an example, right? The Biden administration is apparently calling for government spending to rise to $8.2 trillion by 2031. Why such a large increase in government spending? Well, in my opinion, I think the people demand it. And the US government and the Biden administration, they definitely want to win the important midterm elections next year. And so they're going to keep stimulating that economy. And so if we have inflation lasting longer than people expect, the key question then becomes what happens to interest rates? And what effect would that have on the economy and on markets? Because Typically, interest rates rise in an environment of inflation as people sell their bonds, since you don't really want to own bonds in inflation, as I mentioned in my previous videos many times. But with government and corporate debt levels surging during COVID, the world might not be able to handle higher interest rates because paying off all that debt becomes a major issue if that were to happen. So corporate profits, for example, real corporate profits adjusted for inflation, they haven't moved, they haven't increased in 9 years, but their debt levels have. And so if all of a sudden companies have to start paying more to service that debt with profits staying stagnant, many companies could be in big trouble. And this, combined with a potentially sharp market sell-off that I described earlier, could force central banks to keep supporting markets and to keep printing money. And so this would mean monetary debasement and stagflation, which would be good for things like gold and commodities and even crypto potentially. The optimistic scenario is that inflation rising expands company earnings, which then allows them to pay off debt as long as interest rates rise slowly. And so this would allow central banks to pull back their liquidity and to increase interest rates without blowing up the market. And there would be, in this environment, I think there would be a continued surge in the cyclical and reflation stocks like energy and banks and materials, industrials, everything that the MF portfolio has owned. And it would be bad for things like gold, since real rates would be rising in this environment and gold tends to track real rates. It would also be horrible to any high growth tech stocks. In either situation, I hope it's clear that inflation is not always good for markets, especially if interest rates are rising. So in the late 1960s and 1970s, it definitely wasn't good. So if we go back to the chart and I show you between 1968 and 1972, which is right around here, right? Between 1968, roughly around here, and even 1980, let's say, even further, right? So in this period, so it's around a 12-year time frame, the market just went sideways. It was moving up and down with a lot of volatility, but it didn't go anywhere. It just went sideways. And so that might be good if you are more of an active investor like me, and if you want to invest strategically in sectors that do well during times of inflation. But it's definitely not good for your average passive investor who just buys index stocks like the S&P 500. Inflation is good for the economy and price inflation, but not always good for asset inflation, or at least certain assets that don't do well during inflation. And that leads me to the MF portfolio. In the short term, I think the playbook stays the same. The sectors that we want to continue to own are financials, energy, industrials, and materials. The portfolio performed really well last month. It went up 1.64% compared to the market, which only went up 0.5 or 0.6%. And the high growth ETF ARK was down around 8%. So far in 2021, the portfolio is up 28.2% compared to 13.4% for the market and negative 12% for the ARK ETF. And here's the performance on a chart with the portfolio in orange and the market in gray and the ARK ETF in blue. I made some very minor changes this month. Firstly, I sold Pure Cycle Technologies shortly after my previous top investments video, which was right around here, because shortly after my video, a report came out which put some doubts in my mind regarding the company's prospects. It also put some doubts in the market's mind because the company plunged around like 63% right after I made the video, right? It fell all the way to $10. So it was good. It was a good decision to sell because I sold it around 18. And then at the bottom, I was actually quite lucky in my own personal account. I ended up buying some calls right around the bottom at around $10 and I recovered a lot since then. And then I sold a little bit early. I sold around maybe $17 and it's gone up even more since then. So there's been a big recovery because the company, they demonstrated certain aspects of their technology that restored some of my faith and some of the market's faith. But for now, I haven't bought any stock yet, and I'll sit back and I'll see how it performs going forward. At the very least, I can see that maybe it'll come back down a bit, or it'll pause, it'll take a bit of a breather, and then maybe I can get back at even a lower level than $20 where it's at now. I also added 2 more investments to the portfolio. The first one I mentioned in the description of my previous investment video, and that is ABAX Technologies, ticker symbol ABXX on the Canadian exchange and ABXXF on the US exchange. And it's a small company that is launching a futures market in Singapore for natural gas. Currently, there are no futures contracts for natural gas, and so there's a huge demand for this. And they're also using blockchain technology to track the sustainability of the natural gas being traded on their exchange. So this company is potentially riding the huge tailwind of commodity price inflation in the form of rising natural gas prices, and the whole ESG and blockchain technology trend. And so it's a similarly speculative investment to pure cycle technologies. But after its massive crash, I felt that ABAX fit nicely into the portfolio as a replacement. And finally, following my latest video on crypto, I bought some Bitcoin and I sold some gold to do it. So gold increased a lot this month and it might be peaking right around now. So I felt it would be a good time to take some profits from gold and to transfer them into Bitcoin at a 40% discount. As I mentioned in a previous video, I see the risk reward being very good right now. And actually, just yesterday, the country of El Salvador made Bitcoin legal tender. So it's recognized as a currency or it will be at least. There's a bill proposed to recognize Bitcoin as legal tender, as an actual currency in El Salvador. So there are definitely a lot of positive catalysts coming along the line for Bitcoin and crypto as a whole. So please watch my previous video on crypto to see my other reasons why I think you should own some in your portfolio. And so those were the changes that I made. The portfolio still has a very high allocation to stocks, with now a very small allocation to crypto. And within the stocks, it's still nicely balanced between financials, energy, industrials, materials, with some cannabis sprinkled in. And here's the individual asset allocation. So the plan remains the same. In my opinion, you still want to be exposed to the overall reflation trade and the sectors that do well during increasing growth and increasing inflation. But I'll be keeping my eye on a potential short-term market correction to come. So I might be selling some of the portfolio soon and holding a bit more cash to avoid any downside. We'll see. Longer term, I'll be seeing how the markets move. So will we see signs of reflation continuing strong with strong growth and rising inflation and rising rates? Or will markets get pummeled, forcing central banks to keep interest rates low, leading to lower growth and high inflation? And I'll be looking closely at what the market tells me. So I'll be looking at the dollar, at interest rates, and especially what gold does going forward. Gold has been going up, as I said. It's been going up a lot over the past month, which is good for the portfolio. But gold tends to go up when real interest rates go down. And so gold going up would be the market essentially making the bet that inflation will be high, but GDP growth might be low and central banks might keep interest rates low for a while. And so we'll see, and I'll keep everyone watching updated going forward. Crypto also tends to be a leading indicator for risk sentiment. And in the past, we saw other crypto crashes and crypto pullbacks precede general market pullbacks or market crashes. So we saw that happen in 2018, for example. And so the fact that we saw this massive crash recently puts me a bit on alert for that volatility to potentially translate into the stock market. Once again, I want to reiterate that this is not investment advice, and also realize that I may be wrong, and it definitely won't be the first time. But I'll always do my best to constantly reevaluate my thesis and to listen to what the market is telling me and to admit when I'm wrong. I also hope I didn't get anyone confused about my whole inflation rant. I definitely want to do a dedicated video just on that topic going forward. And I also want to do a video just on Bitcoin and my arguments for and against it more from an economic and a technical perspective. So please look forward to those videos in the future. Thank you guys as always for watching. Be careful in these markets, and I'll see you at the next video.